Oh man, have the fundamentals of Tesla changed? After all, Tesla down over 8.6%, while the NASDAQ 100 up 2.27%, leading a lot of folks, especially retail traders, who were a big support for Tesla stock. Like physically, they underlie a lot of the volume for Tesla stock, helping prop up Tesla prices, and until recently, helping Tesla actually outperform the NASDAQ 100 index year to date. Well, folks, that has all shifted, and there are three major reasons why this has occurred. Now, none of my three reasons are likely things, in my opinion at least, that you've heard of before, at least not with my perspective. See, by now you already know that Tesla deliveries missed consensus expectations by about 5%. But that's not actually my first reason in terms of why Tesla fell. It has to do with something different, an expectation that I think the market has for Tesla that could be entirely wrong. Let's see if that's true, because if it is, it could create an opportunity for Tesla, and towards the end I'll talk about, was this a buy the dip opportunity, or is this time to just sell, forget the FOMO that is Tesla, and move on? Well, first, in order to understand issue number one that I believe the market is seeing, we have to understand that there's a ratio that Tesla has known as delivereds to produced. It's very simple. Just go to Q3 2021, for example, divide 240,000 delivered units, divided by how many units were produced. That means you delivered 240,000 vehicles, which is actually more than you made of 238,000 units, and you have a delivered to produced ratio of 100.8%. When the number's over 100, it means you're actually delivering more vehicles than you've produced. In Q4 2021, that ratio was 101%. Again, you delivered more vehicles than you produced. It actually shows that manufacturing is behind how many vehicles you're selling. In Q1 2022, we were at 101.5. Notice how in those 3 quarters, the number's actually going up. We are delivering more vehicles than we're producing, and production is actually falling behind the deliveries. That signals, at least to the markets, not just supply chain constraints, but it also signals potentially, and well, certainly, a lot of excess demand, right? And this is where it gets interesting. Watch this. When we go to Q2, we notice that we produced 258,000 units, which was obviously low because of the Shanghai shutdowns, but we still produced more vehicles, we produced more vehicles than we delivered. And that was actually a reversal. See, in the quarter of the Shanghai shutdowns, we produced 258,000 vehicles, plus 580, and we delivered 254,695. That means we actually produced more vehicles than we delivered in a month or in a quarter where Shanghai was almost completely shut down. That's interesting. Now when we do the ratio, instead of being over 100%, we're actually at 98.5%. delivered to produced. Now, go to Q3, the numbers that just came out, we produced way more vehicles than we delivered. We produced 365,923 vehicles and delivered only 343, like the studio that makes Halo, 830,000 vehicles. Now, what's interesting about that is, well, 343,830. Let me clarify my numbers there. Sitting at the airport, sometimes the numbers just jarble together. But anyway, what's interesting about that is not only does the production represent a 53% growth rate in Q3 2022 to Q3 2021, but it shows a substantial mismatch between the number of vehicles that we're actually able to deliver and produce. In fact, we only delivered 94% of what we produced. This is a complete reversal from what has consistently been a problem at Tesla. And the problem at Tesla has always been that we're not able to produce enough vehicles compared to what we can deliver. Now, however, markets, just by looking at this data, I believe, are concerned that the excess demand for Tesla is over, that the delivery backlog is not just falling, that it's gone, that now Tesla is no longer a product that we actually think can sell millions of units per year. Sure, maybe we can get to a 1.5 million annual run rate of vehicles, but it's certainly not going to be 3, 4, 5, 6, 10 million vehicles. And it's time to dump Tesla stock. See, the greatest fear for Wall Street when it comes to Tesla is that not that Tesla will produce the vehicles, but that nobody's going to be around to buy them. That's the concern, especially in what's likely a global recession. And these numbers, this ratio flip-flopping from last year being over 100 to now just 94% of produced vehicles being delivered, is a potential red flag to markets. Now, Tesla argues that this is because of what they call a logistic nightmare. And in fairness, they've produced more vehicles than they ever have before. They produced, again, at a 53% growth rate. So maybe that makes sense. Think about it. You want to call up a company to deliver your Tesla from manufacturing facility to distribution facility, and you're like, hey, I got another 10 Teslas. And they're like, dude, we're already doing like 50% more Teslas than you had for us last year at this time. We don't have as many trucks. If you want to pay us like double time to drive your cars around, sure, we'll deliver all of them, but we're going to increase your costs twofold for deliveries. And Tesla might look at that and go, uh-oh, that actually will cause even larger issues to our numbers because that'll compress our margin. If we have to pay another, say, $1,000 or $1,500 just to deliver these vehicles in this quarter, or we just wait a week and still get the same profit we would have otherwise, it just means we have a more disappointing Q3, then we protect our margins. So this is actually a case, in my opinion, of Tesla actually doing what is actually good for shareholders, which is reducing cost and preserving margin, while at the same time, unfortunately, disappointing Wall Street. See, even Elon Musk went to Twitter yesterday and said his job is not to pump the stock. So that leads to temporary pain and a lot of temporary selling at a time when there's not a lot of extra cash and liquidity around to be buying the dip. In fact, retail buy orders have been trending down over the last 2 months. We used to buy the dip at a rate of $1.1 to $1.3 billion per day in the market in terms of retail traders, and now we're under $1 billion a day in buying the dip. It's because the money's running out. And so we got less money to prop up Tesla stock, so to speak. But this now is an argument that Wall Street and Tesla are going to have, and it's one that only time will prove, and it will demand patience. If you're a Tesla bull, you're going to say, look, there's plenty of demand for Teslas. We know that. Like, Tesla's doing the right thing here. They're preserving their margins, especially at a time they're probably going to get whacked by currency exchange fees. I think that in Q3, we're going to probably see somewhere around $1 billion write-down in losses simply for currency exchanges, which is terrible, but that's really problem number 2. We'll get to that in just a moment. And so Tesla decided, you know what, the last thing we need is more of an impact to our margin, because that's going to lead to even more doubt for the company being able to go forward and actually produce vehicles at scale that'll actually create more damage in the long term than just shifting some of these deliveries from Q3 to Q4, basically. So regarding problem number 1, here's my belief. According to at least what we can see on Twitter and in financial news, whether it's Bloomberg or Wall Street expectations, we believe that Tesla still has an order backlog around the world of somewhere around 300,000 vehicles. So we don't have a lack of demand issue. And this is obviously evidenced, or hopefully evidenced, by the fact that we still have lead times for vehicles that rise above and beyond just supply chain constraints or battery constraints. So I actually don't believe we have a demand issue. If Tesla actually has a demand issue, then it should rightfully be down 8.5%. In fact, it probably should be down more. Because if Tesla's demand evaporates, the stock is screwed. You do not want to be anywhere near the stock. And remember, the last time I confidently said something like that was when a firm was like $65, and I'm like, you don't hold this stock going into a recession. Only some people listen to me, but whatever. So problem number 2 is the currency issue. I don't want to just gloss over that. I want to make that very clear. Look, right now, only 55% of Teslas are actually sold within the United States based on the Q2 report. We need that number to go up, because you do not have a strong US dollar issue if more vehicles are sold in the United States. In fact, it actually helps you. The strong dollar helps us if more of the vehicles are sold in the United States. However, if more vehicles are sold in Europe, or in Great Britain with a weak pound or a weak euro, or in China with a weak yuan, even though the Chinese are pulling back, we know that, but even in other areas of Asia, their currencies are weakening compared to the dollar, then we end up having to take an impairment for currency, foreign exchange impairments. Basically, You sell a vehicle for, what should be $45,000 in Chinese yen, let's say, but by the time you convert it to dollars, you're only left with 40,000 because the currency moved that much in a quarter, right? That can happen. That has happened. Just look at Great Britain. It's a disaster. Look at the euro. It's a disaster. So I think that's going to lead to a big $1 billion write-down. That's going to be temporary, though. We can work that out of margin and see that manufacturing is still scaling margin, and we can make projections based on that, which I expect to be quite bullish. The third problem is AI Day. Okay, AI Day was for the stock, a disaster. The robot looked like an idiot. It was very hated on Twitter. It was compared to a robot that took millions of dollars to develop from Honda, that took 20 years to develop. It was compared to Boston Dynamics, who spent 2 decades manufacturing a robot, not at scale, not with a brain, but a programmed robot. And what we got was a robot that looked like it couldn't walk. The new version couldn't walk. The new version looked like it shat itself. And quite frankly, it was a disaster. Now, I covered all of my thoughts on AI Day in my AI Day video because what I actually saw was not a disaster. I saw a 6-month prototype with a brain, and one that could be produced at scale. One that actually makes me incredibly bullish. And I don't even have the Tesla bot in my valuation. That's just extra cream pie, baby. Or extra icing on the cake. I don't know, one of those. Anyway, the other thing is, I was in full self-driving this weekend, and finally, I can say this thing's actually driving a little bit more like a human. It doesn't sit for 10 minutes at a red light on a right turn lane waiting to turn right. It actually goes. It moves. It doesn't stop at a stop sign when nobody's around. It still stops at a stop sign, but what I mean, like, waiting forever. It actually, goes like a human. In some cases, and it shouldn't do this, but in some cases it actually rolls the stop sign, which I actually think is quite hilarious because it is driving like a human, and it's doing it in a way that a human would, but it's actually doing really well. So I personally, breaking apart these issues here, going backwards, FSD, massively bullish, more bullish than I've ever been. And I still don't have it myself. I had to get in somebody else's car. Thank you to the person who let me drive with it, or in it. AI Day, disaster for the stock, phenomenal for AI. By the way, did you notice their labeling was just like the labeling that we do for the HouseHack AI? I got a lot of hate for the HouseHack AI, for the Vision AI that we use for determining wedge deals. They had the same radial buttons, the same look. It was great. It was such an honor. I'm like, damn, Tesla's labeling Vision just like Kevin's labeling Vision. I mean, then they also do Vision video labeling, which is much more impressive. I mean, but that you don't need to video label real estate. It's pretty static. Again, going backwards, the currency issue will be a temporary hit. That will hurt us temporarily. That'll hurt EPS temporarily, which means Tesla will look more rich valuation-wise temporarily. Honestly, the delivery issues, I side with Tesla on this. I don't want them to spend more money squeezing these into the last-minute, delivery process. Save the money on the deliveries. Take a little longer to deliver them. Take your time. But I'm actually really impressed by the production because I know the demand is there. The demand is there, so I'm not worried about the deliveries, even though that ratio is flipped. That's a Wall Street problem. But a 53% growth rate on production? Holy shit. So what did I do? I bought the dip. All right, I bought the dip. I got somewhere around 27K shares, pre-split. Still haven't divided it. I don't know what would that be. Let's just do it in my head right now. That would be 81,000? 25 times 3 is 75. 3 times 2 is 6. Yeah, like 81,000 shares-ish. Something like that. I don't know. I need to actually update it and do the math. But anyway, I bought the dip today. And if we look at the valuation now, it's actually improved. So last time we did my spreadsheet, if you held Tesla for 5 years, I believed that we would get to a target into the 500s. It was like 580 or something like that. You'd have a compounded annual return of like 19%. Well, now, because of this sell-off, if you held Tesla today for 5 years, in my opinion, the compounded annual return for Tesla would be closer to 23% because you're getting it at a lower price. My thoughts. If you haven't heard this stuff before, let me know in the comments down below. I actually want to make sure I continue to provide value that's unique, and I don't want to just rehash the garbage that other people say or tell you to go buy index funds or something boring. Anyway, thank you. Bye.